Somewhere right now, an investor is reading financial news. A founder is studying a competitor. A manager is trying to understand artificial intelligence. A student is deciding what to learn. All of them are looking at the same world. All of them are seeing the same headlines. And yet, 5 years from now, some of them will be dramatically more successful than others. Not because they had access to different information, but because they interpreted that information differently.
That's interesting because we live in a world with almost unlimited information. News is everywhere. Research is everywhere. Data is everywhere. In theory, that should make it easier than ever to understand what's happening. And yet a lot of people seem more confused than ever.
Historically, information has rarely been the only bottleneck. During many major technological revolutions, the information required to understand what was happening was available before the implications became obvious. The challenge was not only access to information, the challenge was interpretation.
Exactly, and that's where today's idea begins. Most people see events, winners see patterns. Most people focus on what happened. Winners focus on why it happened. Most people react to the visible move. Winners try to understand the forces underneath the move.
So when you say seeing the board, you're not talking about prediction. You're not saying some people can magically see the future.
No, in fact, I would argue that's one of the biggest misunderstandings in business, investing, and even life. People think successful individuals are better predictors. Sometimes they are, but more often, they're better observers. They understand the present more deeply than everyone else. And because they understand the present better, they tend to make better decisions about the future.
Chess provides a useful analogy. A beginner sees pieces. A master sees positions. The pieces are visible to everyone. The position is what creates the advantage. The same principle appears repeatedly in business, technology, and investing.
That's actually a powerful distinction because most people spend their time looking at the pieces. They look at the stock price, the product launch, the quarterly earnings report, the election result, the AI model release.
Exactly, those are the pieces. But the pieces are rarely the story. The story is the position. Let me give you an example. When most people look at NVIDIA today, they see a company selling chips. That's the piece. Someone who sees the board sees something very different. They see artificial intelligence increasing demand for computation. They see data centers expanding. They see power consumption rising. They see capital flowing into infrastructure. They see governments competing for technological leadership. Suddenly, the company is no longer the story. The company becomes one expression of a much larger pattern.
So one person sees a stock, another person sees a system.
Exactly. And the person who sees the system usually has an advantage because systems move more slowly than headlines. The headlines change every day. The underlying forces often develop over years.
History repeatedly demonstrates this. The internet did not appear overnight. The smartphone revolution did not appear overnight. Social media did not appear overnight. The visible breakthrough often arrives after years of gradual change that most people ignored.
Which explains why everything looks obvious in hindsight.
Exactly. Think about smartphones. Today, it feels inevitable. Of course, everyone carries a powerful computer in their pocket, but 20 years ago, that wasn't obvious. Most people looked at existing phones and assumed the future would be a slightly better version of the present. A few people saw multiple trends converging: better batteries, faster processors, better networks, lower component costs, expanding internet access. They weren't predicting a specific device. They were seeing the board.
That's interesting because it sounds like the future is often hidden inside multiple trends that are already visible today.
That's exactly right. The future usually leaves clues. The challenge is recognizing which clues matter, and that's where most people struggle. They focus on isolated events rather than connected patterns.
One way to think about this is through consequence chains. Most people stop at the first consequence. Strategic thinkers keep going. If artificial intelligence improves, what follows? If that happens, what follows? And if that happens, what follows? The second and third order effects are often more important than the original event.
That's our consequence thinking framework.
Exactly. And it's one of the most practical ways to learn how to see the board. Imagine someone says, AI is getting better. Most people stop there. But let's keep going. If AI gets better, what follows? More tasks become automated. If more tasks become automated, what follows? The value of routine work declines. If routine work declines in value, what follows? Judgment, creativity, trust, and decision-making become more valuable. Suddenly, you've moved from a technology story to a career story, and then maybe an investing story, and then maybe a business opportunity.
That's actually fascinating because the original statement was just 4 words. AI is getting better. But by following the consequences, you've uncovered multiple opportunities that weren't obvious at first glance.
And that process has repeated throughout history. The biggest opportunities often emerge from the consequences of change rather than the change itself. Railroads created opportunities beyond transportation. The internet created opportunities beyond connectivity. Smartphones created opportunities beyond communication. AI will likely do the same.
Which brings us to something important. Seeing the board is not about becoming smarter than everyone else. It's about learning where to look. Most people look directly at the event. The people who consistently get ahead ask different questions. What forces created this event? What trends are converging? What follows if this continues? What becomes more valuable? What becomes less valuable? Where does the bottleneck move next?
And those questions work almost everywhere: business, investing, technology, careers, even personal decisions.
Exactly, because underneath all those domains, the same patterns keep appearing. Incentives, feedback loops, bottlenecks, network effects, power laws, optionality, second-order consequences. The names change, the industries change, the technologies change, but the patterns remain surprisingly consistent.
Which is one reason studying patterns can create such a large advantage. Events come and go. Patterns often persist for decades.
So maybe that's the real difference. Most people are trying to understand today's headline. The people who see the board are trying to understand the rules that keep generating the headlines.
Exactly. And once you begin seeing the rules, something remarkable happens. The world starts to feel less random. The headlines become easier to interpret. Opportunities become easier to spot. Risks become easier to identify. You stop feeling like you're reacting to the future and start feeling like you're preparing for it. Because the people who consistently win are rarely the people who react the fastest. More often, they're the people who recognized the pattern first. And that raises a fascinating question. If patterns matter more than events, what are the most important patterns shaping the board right now? If you ask most people why something happened, they'll usually point to an event. A company succeeded because it launched a great product. A stock rose because of earnings. A politician won because of a speech. A technology became popular because it was better. And sometimes those explanations are partially true, but they're usually incomplete because events don't emerge from nowhere. They emerge from forces that were already moving beneath the surface.
So this is where we start looking underneath the board instead of just looking at the pieces.
Exactly. Because once you start looking underneath the board, you discover something surprising. The same forces appear over and over again. Different industries, different countries, different technologies, different centuries. Yet many of the underlying patterns remain remarkably similar.
Historians often encounter this phenomenon. The specific events change, the actors change, the technologies change, but certain recurring structures continue appearing. Incentives, competition, feedback loops, bottlenecks, coordination problems, human psychology, different story, similar mechanics.
That sounds almost like physics. Different objects, same laws.
That's actually a very useful way to think about it. If you throw a baseball, a tennis ball, or a rock, gravity still applies. In the same way, if you're looking at a startup, a government, a stock market, or an AI company, many of the same systemic forces still apply. The details change. The patterns often don't.
So where do we start? If someone wants to learn how to see the board, what's the first thing they should look for?
Incentives. almost always incentives, because incentives are one of the most powerful forces in any system. If you want to understand behavior, stop listening to what people say and start looking at what rewards them.
This principle appears repeatedly throughout history. Organizations often behave exactly as their incentive structures encourage them to behave, even when the outcomes appear irrational from the outside.
Give me an example.
Imagine a company where executives receive large bonuses for hitting quarterly targets. Even if everyone talks about long-term thinking, the incentive is focused on the next quarter. What happens? People optimize for quarterly performance. Costs get cut. Investments get delayed. Long-term projects become harder to justify. The incentive quietly shapes behavior.
So even smart people can end up making bad long-term decisions if the incentives point in the wrong direction.
Exactly. And once you understand that, you start seeing incentives everywhere. Social media platforms optimize for engagement. Politicians optimize for votes. Companies optimize for profits. Employees optimize for promotions. Investors optimize for returns. Understanding incentives often tells you more than listening to promises.
In many cases, incentives are better predictors of future behavior than stated intentions.
That's actually a little uncomfortable because it means many systems produce outcomes nobody explicitly wanted.
That's true, and it leads directly to the second force we need to understand: feedback loops.
Feedback loops sound complicated, but they're actually everywhere, aren't they?
Everywhere. A feedback loop is simply a process where success creates more success or failure creates more failure. Think about social media. More users create more content. More content attracts more users. More users create even more content. The loop reinforces itself.
The same pattern appears in business, investing, and technology. Small initial advantages often become larger advantages over time because the system rewards existing momentum.
Which explains why some companies seem impossible to catch once they get ahead.
Exactly. Most people look at the outcome and say, they're winning because they're big. But often they're big because a feedback loop has been operating for years. Amazon didn't wake up one day as Amazon. The system compounded. More customers led to more sellers. More sellers led to more selection. More selection attracted more customers. The loop reinforced itself.
That's interesting because most people see the size. They don't see the engine creating the size.
And that's a recurring theme throughout this episode. The visible outcome is usually not the most important thing. The underlying force is.
Which also explains why copying visible outcomes often fails. Competitors copy the product, but fail to recreate the feedback loop that made the product successful.
That's a really important point because people often ask, why doesn't someone just build another Amazon?
Exactly. They're looking at the result instead of the process. It's like trying to recreate a tree without understanding the roots.
So we've got incentives and feedback loops. What comes next?
Consequences, specifically second-order consequences. Because one of the biggest differences between average thinkers and strategic thinkers is how far they follow a chain of events.
Meaning, most people stop too early.
Exactly. Someone hears that AI is getting better. That's the first-order observation. Strategic thinkers immediately ask, what follows? If AI gets better, what tasks become cheaper? If those tasks become cheaper, what skills become more valuable? If those skills become more valuable, what businesses benefit? If those businesses benefit, what opportunities emerge? They're following the chain further.
Historically, the largest fortunes and the largest strategic advantages often emerge from second and third order effects rather than first order effects.
Which means the opportunity is often not where everyone is looking.
Exactly. Everyone looks at the event. Fewer people look at the consequence. Even fewer people look at the consequence of the consequence. That's often where value hides.
This is starting to feel like a completely different way of looking at reality.
It is. Most people experience the world as a stream of events. People who see the board experience the world as interacting systems. Incentives influence behavior. Behavior creates feedback loops. Feedback loops create outcomes. Outcomes create consequences. Consequences create new opportunities and new constraints. The system is constantly evolving.
And once you begin seeing those interactions, many events become easier to interpret, not because they're predictable, but because they're no longer isolated.
Exactly, which brings us to one of the most powerful questions in strategic thinking. If these invisible forces are constantly shaping outcomes, where does value actually go as the world changes? Let's talk about one of the most powerful forces on the board: feedback loops.
The force that makes winners keep winning?
Sometimes, yes. A feedback loop occurs when an outcome reinforces the process that created it. In simple terms, success creates conditions that make additional success more likely.
Feedback loops appear throughout history. Cities, empires, businesses, technologies, and even personal careers often grow through reinforcing cycles rather than linear progress.
Give me a business example.
Amazon is a classic example. More customers attract more sellers. More sellers create more selection. More selection attracts more customers, which attracts more sellers. The cycle reinforces itself.
That's the famous flywheel.
Exactly. And once a flywheel gains enough momentum, competitors face a difficult challenge. They're not fighting a company. They're fighting a system that gets stronger every time it succeeds.
Historically, many dominant businesses have been built around reinforcing loops rather than individual products.
Which means products matter less than systems.
Often, yes, products can be copied. Systems are much harder to copy.
What about network effects?
Network effects are a specific type of feedback loop. The more users join a network, the more valuable the network becomes for every participant.
The telephone network is a classic historical example. One telephone is useless. Two telephones create value. A million telephones create enormous value because everyone can communicate with everyone else.
Which means the network becomes more useful as it grows.
Exactly. That's why certain businesses become incredibly difficult to challenge once they reach critical mass.
Social media works the same way.
It does. Imagine launching a new social network. The technology may be excellent. The interface may be better. But if your friends aren't there, the network has little value. The existing network already owns the relationships.
This explains why many technically superior products fail against entrenched incumbents.
Because they're competing against the network rather than the product.
Exactly. Most people see the visible product. They don't see the invisible network underneath it.
That's becoming a theme in this episode.
It is. Seeing the board often means identifying invisible forces.
Let's talk about Netflix and Blockbuster.
Great example. Most people think Netflix beat Blockbuster because of streaming technology. That's only part of the story. The deeper story involves feedback loops. Netflix gathered viewing data from millions of users. That data improved recommendations. Better recommendations increased engagement. Higher engagement generated more data. The loop reinforced itself.
Over time, the company's understanding of viewer behavior became a strategic asset.
Which means the advantage wasn't just streaming.
Exactly. The advantage was a system that improved every time customers used it.
That's a powerful idea.
It becomes even more important in the age of AI.
Because AI systems also learn from feedback.
Correct. More users generate more interactions. More interactions generate more data. Better data improves products. Better products attract more users. The loop continues.
Many of today's leading AI companies benefit from some version of this dynamic.
Which means when we evaluate a company, we shouldn't only ask how good the product is.
Exactly. Ask a deeper question. Does success create more success? Does every new customer strengthen the system? Does every new participant make the network more valuable?
That's a very different way of looking at business.
It is. Most people evaluate snapshots. Strategic thinkers evaluate dynamics.
And dynamics often determine long-term outcomes more reliably than static measurements.
So when we're seeing the board, we're looking for loops rather than isolated events.
Exactly. Because once you identify a powerful feedback loop, you begin seeing why some advantages compound for years while others disappear almost immediately.
Which means one of the smartest questions on the board might be, what happens if this succeeds?
And then, does that success make future success easier or harder? If the answer is easier, you've probably discovered a feedback loop worth paying attention to. One of the most important questions on the board is surprisingly simple. Why do some advantages grow while others disappear?
That's actually a fascinating question, because if you look around the world, the biggest winners often don't seem a little ahead. they seem dramatically ahead.
Exactly, and that's where feedback loops enter the picture. Feedback loops are one of the most powerful forces shaping outcomes. They explain why a small lead can become a large lead, why success often attracts more success, and why seemingly small differences can compound into enormous gaps over time.
Many of history's largest companies, fortunes, and institutions were built on feedback loops. The mechanism appears repeatedly across industries, technologies, and markets.
So what exactly is a feedback loop?
At its simplest, a feedback loop occurs when an outcome reinforces the process that created the outcome. Success creates conditions for more success. Failure creates conditions for more failure. The loop feeds itself.
Give me a practical example.
Let's start with something everyone understands: learning. Imagine two students. One learns a subject slightly faster than the other. Because they understand more, they enjoy it more. Because they enjoy it more, they spend more time on it. Because they spend more time on it, they improve faster. The advantage grows.
So the initial difference might have been small, but the loop makes it larger.
Exactly. The loop compounds. That's the key idea.
Researchers often observe this phenomenon in education, careers, and skill development. Early advantages frequently create conditions that reinforce future advantages.
That sounds almost unfair.
Sometimes it is. But understanding the pattern matters more than judging it, because feedback loops operate whether we notice them or not.
And I assume they exist in business too.
Absolutely. Let's look at Amazon. More customers attract more sellers. More sellers create more selection. More selection attracts more customers. More customers attract more sellers. That's a feedback loop.
So every turn of the wheel makes the next turn easier.
Exactly. And eventually, the wheel develops momentum. That's when competitors begin asking a dangerous question. How did they get so far ahead?
What's interesting is that observers often notice the outcome long after the feedback loop has been operating. By the time the advantage becomes obvious, the underlying mechanism may have been strengthening for years.
That's another pattern we're seeing throughout this episode. People notice outcomes. Winners notice processes.
Exactly. Outcomes are usually lagging indicators. The process is what matters.
Give me another example.
Social media platforms provide a good one. More users create more content. More content attracts more users. More users create more content. The loop reinforces itself.
Which explains why so many social platforms look unstoppable once they reach critical mass.
Exactly. But here's something important. Not all feedback loops are positive. Some are destructive.
Meaning failure can compound too.
Absolutely. Imagine a company that starts losing customers. Lower revenue leads to reduced investment. Reduced investment weakens the product. A weaker product causes more customers to leave. The loop begins reinforcing decline.
History contains many examples of dominant companies entering negative feedback loops and struggling to reverse them.
That's interesting because it suggests success and failure are often more dynamic than people realize.
Exactly. Most people see a snapshot. They see the current state. People who see the board look for the loop. Is this system reinforcing itself? Is it accelerating? Is it weakening? That's often a much more useful question.
This reminds me of investing.
It should. Great investors spend enormous amounts of time identifying positive feedback loops. Businesses that improve as they grow. Companies that become stronger because they're already strong.
Like network effects?
Exactly. Network effects are often a specialized form of feedback loop. More users create more value. More value attracts more users. The system becomes self-reinforcing.
Many of the largest technology companies in history benefited from both network effects and feedback loops, operating simultaneously.
So if somebody wants to find opportunities, one question might be, where are positive feedback loops forming?
That's a great question. In fact, it's one of the most useful questions on the board because a positive feedback loop can transform an ordinary opportunity into an extraordinary one.
Let's connect this back to AI. Where are the feedback loops?
There are several. Better AI creates more users. More users create more data and feedback. More feedback improves products. Better products attract more users. That's one loop. Another loop appears at the company level. Organizations that successfully adopt AI become more productive. Higher productivity creates more resources. more resources support further AI adoption.
Which means the gap between adopters and non-adopters could widen over time.
Exactly. And that's where consequence thinking becomes useful again. If AI adoption creates productivity gains, what follows? Some companies move faster. What follows? Market share shifts. What follows? Talent follows opportunity. What follows? The leaders strengthen further. You can see the loop developing.
Historically, technological revolutions often produce reinforcing advantages for early adopters, particularly when the technology improves productivity or decision quality.
That's actually a little scary, because once the loop starts, catching up becomes harder.
Sometimes. But it also creates opportunity. Every major technological wave creates new feedback loops. The challenge is recognizing them early.
So if bottlenecks tell us where value moves, feedback loops tell us where value compounds.
Exactly. That's a perfect way to think about it. Bottlenecks reveal opportunity. Feedback loops amplify opportunity.
And when both appear together, the results can be extraordinary.
That's interesting, because it sounds like the biggest winners aren't simply solving problems. They're solving bottlenecks that happen to sit inside powerful feedback loops.
Exactly. And when you begin seeing those interactions, the board starts becoming much clearer. Because the world isn't just a collection of isolated events. It's a collection of interacting forces. Bottlenecks move. Feedback loops reinforce. Incentives guide behavior. Consequences unfold.
And some of those forces are powerful enough to create outcomes that seem almost impossible when viewed from the beginning.
Exactly. Which brings us to another pattern that explains why a small number of people, companies, and investments often capture a disproportionate share of the rewards.
The pattern economists call power laws.
And once you understand power laws, you begin to realize that the world is far less evenly distributed than most people imagine. One of the biggest mistakes people make is assuming the world is fair, balanced, and evenly distributed.
Because it isn't.
Not even close. Most people intuitively think outcomes follow a normal distribution. They imagine success is spread relatively evenly. But in many important systems, that's simply not how reality works.
Economists, venture capitalists, and investors often describe these environments as power law systems. A small number of outcomes generate a disproportionate share of total results.
Give me a simple example.
Venture capital. Most startup investments fail. A few survive. An even smaller number become extraordinary. Yet a single company can generate more returns than dozens of failures combined.
Companies like Google, Amazon, Nvidia, Meta, and Microsoft have created trillions of dollars in value. Their impact dwarfs thousands of businesses that disappeared along the way.
Which means the average outcome tells you almost nothing.
Exactly. That's one of the most important lessons in seeing the board. In power law environments, averages become misleading. A few exceptional outcomes drive most of the results.
That changes how you think about investing.
It changes how you think about almost everything: careers, businesses, content creation, technology, innovation. Many of the systems that shape modern life are dominated by a small number of extraordinary winners.
This is why a handful of creators capture most attention online. A handful of companies capture most profits. A handful of investors capture most returns.
Which sounds depressing if you're not one of them.
Unless you understand optionality.
Explain.
Optionality is the ability to participate in asymmetric outcomes. You don't need to know exactly which opportunity becomes the winner. You need exposure to opportunities where the upside dramatically exceeds the downside.
Historically, many successful investors built their fortunes by consistently placing asymmetric bets rather than accurately predicting every outcome.
Warren Buffett comes to mind.
Exactly. Buffett often talks about finding situations where the downside is limited and the upside is significant. He doesn't need every investment to succeed. A few exceptional investments can dominate decades of results.
Which means success isn't always about being right all the time.
It's often about being positioned correctly when something extraordinary happens.
This principle appears repeatedly throughout history. Explorers, entrepreneurs, inventors, investors, and innovators frequently benefit from asymmetric outcomes. A small number of decisions create most of the value.
That's interesting because most people spend their lives trying to avoid mistakes.
Exactly. They optimize for certainty, but power law environments reward exposure to opportunity more than perfection.
So, seeing the board means recognizing what type of game you're playing.
That's a huge insight. In some environments, consistency matters most. In others, a few extraordinary outcomes dominate everything. If you misunderstand the structure of the game, you'll allocate your time, attention, and resources incorrectly.
Many people apply industrial age thinking to exponential age environments. They expect linear results from systems that are fundamentally nonlinear.
Which means they underestimate how much one breakthrough can matter.
Exactly. Think about Amazon, think about Google, think about NVIDIA, think about OpenAI. Most of the value was not created gradually. It arrived through a combination of compounding, scale, and asymmetric outcomes.
That's another recurring pattern in this episode.
It is. Power laws rarely exist in isolation. They're usually connected to feedback loops, network effects, scalability, and bottleneck shifts. The strongest opportunities often sit at the intersection of multiple forces.
Which is why seeing the board requires looking at systems rather than individual variables.
Let me see if I've got this. Most people ask, what's the average outcome? Strategic thinkers ask, what are the extreme outcomes and how do I position myself to benefit if they occur?
Exactly. That's the essence of optionality. You don't need certainty. You need favorable asymmetry.
And that's a very different way of looking at risk.
It is. Risk isn't simply the probability of being wrong. Risk is often the possibility of missing an opportunity that could change everything.
Which means some of the safest looking decisions can be surprisingly expensive over long periods of time.
And some of the most valuable positions on the board begin as small, uncertain opportunities that most people ignore.
That's probably why the future often rewards people who can tolerate uncertainty better than the crowd.
Exactly, because in power law environments, the biggest rewards frequently emerge from places where the outcomes are impossible to predict with precision. Few words create more confusion than luck. When people see extraordinary success, they often explain it with a single sentence. They got lucky. A founder builds a billion-dollar company. Lucky. An investor discovers a winning stock. Lucky. A creator attracts millions of followers. Lucky. Someone lands the perfect opportunity at exactly the right time. Lucky.
And to be fair, luck does exist.
Absolutely. Luck is real. The problem is that people often stop their analysis there. They use luck as an explanation when it should be the beginning of a deeper question.
Historically, many successful individuals experienced favorable circumstances. The more interesting question is why some people seem to encounter favorable circumstances repeatedly.
That's actually true. Everyone knows people who seem to get lucky over and over again.
Exactly, which raises an important question. Are they simply luckier than everyone else, or are they positioning themselves differently?
I suspect I know where this is going.
Most people think luck is something that happens to them. Strategic thinkers often treat luck as something they can increase exposure to.
Explain that.
Imagine two people. The first spends 10 years doing the exact same thing. Same environment, same network, same routines, same opportunities. The second spends 10 years learning new skills, meeting new people, exploring emerging technologies, testing ideas, launching projects, and placing small bets on uncertain opportunities. Which person is more likely to encounter unexpected opportunities?
The second person, obviously.
Exactly. Not because they can predict the future, because they have more exposure to possibility.
Many breakthrough opportunities emerge from interactions between different people, industries, technologies, and ideas. Increasing exposure to those intersections naturally increases the probability of encountering valuable opportunities.
So luck is partly a positioning problem.
Very often. Which brings us to one of the most important concepts on the board: optionality.
One of my favorite concepts.
Mine too. Optionality is the ability to benefit from favorable outcomes without requiring certainty beforehand. In simple terms, it's creating situations where the upside is large and the downside is manageable.
That sounds simple, but most people seem to do the opposite.
Exactly. Most people seek certainty. They want guarantees before they act. They want to know exactly how things will work out. The problem is that extraordinary opportunities rarely arrive with certainty attached.
Historically, many transformational opportunities looked uncertain at the time. The internet, Smartphones, cloud computing, and artificial intelligence all carried significant uncertainty during their early phases.
If everyone knew they would become huge, there wouldn't have been much opportunity.
Exactly. Opportunity often lives inside uncertainty. That's why optionality matters so much. Instead of demanding certainty, you position yourself so that favorable outcomes can benefit you if they occur.
That's a very different mindset.
It is. Most people ask, will this work? People who see the board often ask, what happens if it works?
That's subtle, but powerful.
Very powerful. Imagine someone learning AI in 2024. They couldn't know exactly how important AI would become, but the downside was limited. They would learn useful skills. The upside, however, could be enormous if AI transformed industries. That's optionality.
Similar patterns appeared during previous technological transitions. Early exposure frequently provided asymmetric benefits when the technology achieved widespread adoption.
Let's connect this to investing.
Investing is one of the clearest examples. Great investors often seek asymmetric opportunities, limited downside, significant upside. They understand they do not need certainty. They need favorable risk-reward relationships.
Which sounds very similar to your small cap framework.
Exactly. Imagine a stock with potential to increase 5 or 10 times while risking a relatively small allocation. You don't need every position to succeed. You need exposure to favorable asymmetry.
This logic appears repeatedly in venture capital, entrepreneurship, scientific research, and innovation. Multiple small experiments create opportunities for occasional outsized outcomes.
So maybe luck isn't the right word.
That's exactly where I'm going. Many people describe the outcome as luck, but they're observing the result rather than the positioning that preceded the result.
It's like seeing a tree and ignoring the years spent planting and watering seeds.
Exactly. And here's where consequence thinking becomes useful again. If someone increases their optionality, what follows? They encounter more opportunities. If they encounter more opportunities, what follows? They increase the probability of favorable surprises. If favorable surprises occur more frequently, what follows? Observers begin calling them lucky.
That's actually funny because it happens all the time.
Humans naturally focus on visible outcomes. The invisible positioning process often receives far less attention.
Which means one of the most valuable questions on the board is not, how do I eliminate uncertainty? It's how do I benefit from uncertainty?
That's a completely different question.
And it produces completely different behavior. Instead of waiting for certainty, you run experiments. Instead of demanding perfect information, you gather exposure. Instead of trying to predict every outcome, you build optionality.
Adaptive systems frequently outperform predictive systems when uncertainty is high.
Which is a really important lesson in an AI world.
Absolutely. Nobody knows exactly how AI evolves over the next decade. Nobody knows exactly which companies win. Nobody knows exactly which careers benefit most. But people can position themselves intelligently. They can learn, experiment, build networks, explore opportunities, create optionality.
And the people who do that will probably look very lucky in hindsight.
Exactly, which brings us to another pattern, because if optionality helps explain how opportunities emerge, we still need to understand how those opportunities evolve into major changes. And that requires learning how to follow consequences further than most people do.
Which brings us directly into second-order thinking.
Exactly. Because the people who see the board rarely stop at the first move. They keep asking one question. What happens next?
Which leads naturally to another pattern that helps explain why some people seem unusually fortunate throughout their lives.
The luck conversation.
Exactly, because once you understand power laws, you start realizing that luck may not be as random as it first appears. Let me ask a question. What was the most important consequence of the smartphone?
Easy. Mobile internet.
That's what most people would say, and it's not wrong, but it's incomplete, because the most important consequences of a technology are often not the technology itself. They're the things the technology makes possible.
Historically, many of the largest fortunes in industries emerged from second-order effects rather than first-order effects.
Give me an example.
Let's go back to 2007. Steve Jobs walks onto a stage and introduces the iPhone. Most people see a better phone. That's the first order effect. But almost nobody sees Uber. Almost nobody sees Airbnb. Almost nobody sees food delivery apps, mobile banking, ride sharing, or entire industries that didn't exist yet.
Because they were focused on the phone itself.
Exactly. Strategic thinkers ask a different question. Not, what does this technology do, but what does this technology change? That's where second order thinking begins.
The smartphone wasn't valuable because it was a phone. It was valuable because hundreds of millions of people suddenly carried an internet-connected computer with GPS in their pockets. That changed the economics of entire industries.
So the biggest opportunities weren't inside the phone, they were downstream from the phone.
Exactly, and that's one of the most important lessons in seeing the board. The first order effect gets the headlines. The second order effects often create the fortunes.
That's a great line.
Think about Amazon. Most people saw an online bookstore. Amazon saw something else. They saw logistics, infrastructure. They saw distribution. They saw systems that could eventually sell almost anything.
The first order effect was selling books online. The second order effects eventually included e-commerce dominance, cloud computing, digital advertising, and one of the most valuable businesses ever created.
Which means if you only looked at the bookstore, you completely missed the real story.
Exactly. The visible product was not the most important asset. The invisible system was.
That's starting to sound very much like seeing the board.
Because that's exactly what it is. Most people focus on pieces. Strategic thinkers focus on positions. Most people focus on events. Strategic thinkers focus on forces.
And the difference becomes increasingly important as systems become more complex.
Let's bring AI into this.
Great idea. Right now, most people are focused on AI itself. They're asking whether ChatGPT is better than another model, whether one company has a larger model than another, whether intelligence is becoming cheaper. Those are reasonable questions, but they may not be the most important questions.
Because there are second-order effects coming.
Exactly. If AI dramatically reduces the cost of intelligence, what follows? If intelligence becomes abundant, what becomes scarce? If content becomes free, what becomes valuable? If software development becomes easier, what industries reorganize? If every company gains AI employees, what new bottlenecks emerge?
Those questions often create more value than debating the technology itself.
Which sounds a lot like consequence thinking.
That's because consequence thinking is one of the engines inside seeing the board. You start with a change, then you ask, what follows? Then what follows after that? Then what follows after that?
Most people stop after one step.
Exactly. That's where opportunity emerges. Imagine two investors looking at AI. One sees a technology trend, the other sees future consequences. More data centers, more electricity demand, more cooling infrastructure, more specialized chips, more automation, more verification systems, more trust layers. Suddenly, they're not looking at one opportunity, they're looking at an entire landscape.
Many successful investment theses originate several layers away from the original trend.
That's actually how some of the biggest fortunes are made.
It is. Not by seeing what everyone else sees, but by seeing what everyone else hasn't followed far enough.
That's a powerful distinction.
It really is, and it explains why some people appear to predict the future. Most of the time, they're not predicting. They're simply following consequences further than the crowd.
Which often makes their conclusions appear obvious in hindsight.
That's one of the funniest things about history. The biggest shifts always seem obvious afterward.
Exactly. Once Uber exists, the smartphone opportunity seems obvious. Once Amazon dominates commerce, the online bookstore story seems obvious. Once AI transforms industries, the clues will seem obvious. But the advantage always exists before the outcome becomes obvious.
Which means one of the most valuable questions on the board might be, what follows?
Exactly. Not once, not twice. Keep asking until the consequences start revealing opportunities nobody is talking about yet.
Because the future often arrives gradually through chains of consequences rather than sudden events.
And the people who learn to follow those chains gain one of the most powerful advantages available in business, investing, technology, and life. Throughout this episode, we've explored the forces shaping the board: incentives, Feedback loops, bottlenecks, power laws, optionality, second-order effects. But understanding patterns is only half the game. The real question is simple. How do you use them?
Exactly. Because it's one thing to understand why Amazon won, it's another thing to make better decisions on Monday morning.
Knowledge becomes valuable when it changes behavior. Otherwise, it remains intellectual entertainment.
And that's where many people get stuck. They become collectors of ideas instead of users of ideas. They learn frameworks, they read books, they watch videos, but their decisions remain unchanged.
That's actually a dangerous trap, because learning feels productive.
Exactly. It feels like progress. Sometimes it is. Sometimes it's simply consumption disguised as progress. Seeing the board only matters if it changes how you allocate your time, attention, capital, and effort.
So let's make it practical. If someone listening wants to start playing the board better tomorrow, where should they begin?
Start by asking a different set of questions. Most people ask, what happened? Strategic thinkers ask, why did it happen? What forces created it? What follows next?
That's surprisingly simple.
The best frameworks often are. Imagine reading a headline. AI company raises $10 billion. Most people stop there. Someone who sees the board asks, why are investors willing to commit that much capital? What bottleneck are they trying to solve? What industries benefit if they're right? What industries suffer? What follows?
The quality of questions often determines the quality of insights.
Which means the goal is not collecting more information. The goal is extracting more signal from existing information.
Exactly. Most people are drowning in information and starving for understanding.
That's a great line.
Because it's increasingly true. Every year we gain more information. But information alone does not create advantage. Interpretation creates advantage.
Historically, major fortunes and major strategic advantages often emerged from superior interpretation rather than superior access to information.
Which is actually good news, because information is becoming more accessible than ever.
Exactly. That's one reason I'm optimistic. The tools available today are extraordinary. AI can summarize information. Search can retrieve information. Databases can store information, which means human advantage increasingly shifts toward understanding and judgment.
There's the judgment premium again.
Exactly. The models keep connecting. That's how you know they're describing reality rather than isolated ideas.
Let's talk careers. How does someone apply seeing the board professionally?
One question. What skills are becoming more valuable because of current trends? Most people ask what skills are valuable today. Strategic thinkers ask what skills become valuable tomorrow.
Give me an example.
AI is automating certain forms of routine knowledge work. What follows? Judgment becomes more important. Communication becomes more important. Leadership becomes more important. Trust becomes more important. Systems thinking becomes more important. Those skills sit closer to the emerging bottlenecks.
Historically, periods of technological change often shifted value toward capabilities that complemented the new technology rather than competed directly against it.
So don't compete with the abundance. Move toward the scarcity.
Exactly. That's one of the simplest ways to play the board.
What about investing?
Investing is largely an exercise in consequence thinking. Every investment is ultimately a belief about the future. The question is whether you've followed the consequences further than the market has.
That's interesting.
Imagine AI demand continues growing. Most investors stop at semiconductor companies. That's fine. But someone seeing the board asks additional questions. What follows? More data centers, more electricity demand, more cooling demand, more infrastructure spending, more transmission requirements. Entire chains of consequences emerge.
Many successful investment theses originate several layers away from the original trend.
Which is another reason second-order thinking matters.
Exactly. Opportunities often hide where fewer people are looking.
Let's talk business.
In business, seeing the board often means identifying the real bottleneck. Many organizations spend years optimizing non-constraints. They improve things that don't actually matter.
That's painful, because it's true.
Very true. Imagine a company improving internal reporting systems while customer acquisition is collapsing. They're solving the wrong problem. The board is telling them one thing. They're focusing on another.
Theory of constraints. Research repeatedly demonstrates that system performance is often determined by a small number of limiting factors.
So the question becomes, what's actually holding the system back?
Exactly. That's often the highest leverage question available.
This is starting to feel like a superpower.
In some ways it is. Not because it makes you smarter than everyone else, because it helps you focus on what matters. Most people scatter attention across dozens of variables. Seeing the board helps identify the few variables that actually drive outcomes.
Complexity often creates the illusion that everything matters equally. Reality rarely works that way.
That's another power law idea.
Exactly. A small number of causes often explain a large percentage of results.
So, if we compress everything we've discussed so far into one lesson, what would it be?
Stop asking what happened. Start asking what system produced what happened. That single shift in perspective can transform how you think about business, investing, technology, and life.
Because once you understand the system, you can often anticipate where things are going.
Exactly, not perfectly, but better than someone staring only at events.
And over long periods of time, small improvements in decision quality compound dramatically.
Which leads us to the final question of this episode. If the world is increasingly complex, increasingly interconnected, and increasingly driven by systems rather than isolated events, what does the modern strategist actually look like?
In other words, what kind of person wins on the board we're entering?
Exactly, and that's where we'll finish. Let's imagine two people entering the next decade. They have access to the same internet, the same artificial intelligence tools, the same information, the same opportunities. Yet 10 years later, their outcomes look completely different. Why?
That's really the question behind this entire episode.
Exactly, because if information is abundant, then information alone cannot be the explanation. If AI becomes abundant, then AI alone cannot be the explanation. Something else determines the difference.
Historically, technological revolutions tend to reduce the value of certain advantages while increasing the value of others. The people who adapt to the new structure often outperform those who continue optimizing for the old one.
Which sounds simple, but most people don't adapt very quickly.
That's true. One of the most common mistakes in history is assuming tomorrow will look roughly like today. People project the present forward. They assume existing advantages remain valuable forever. They assume existing bottlenecks remain bottlenecks forever. They assume existing winners remain winners forever.
History says otherwise.
Repeatedly, the printing press changed the value of information. The steam engine changed the value of labor. Electricity changed the value of location. The internet changed the value of distribution. AI is changing the value of intelligence itself.
And each transition rewarded people who recognized the shift earlier than the crowd.
So what does the modern strategist actually do differently?
First, they think in systems rather than events. Most people consume headlines. The strategist studies forces. Most people react to outcomes. The strategist studies causes.
That's basically the foundation of seeing the board.
Exactly. They understand that events are usually symptoms. The real story is happening underneath.
This often creates a timing advantage. By the time an outcome becomes visible, the underlying forces may have been developing for years.
What's the second difference?
They think in consequences rather than predictions.
Explain that distinction.
Most people ask, what will happen? The strategist asks, if this happens, what follows? It's a subtle shift, but it changes everything. One approach tries to predict the future. The other explores possible futures.
Which is much more realistic.
Exactly. The future contains uncertainty. Consequence thinking embraces uncertainty while still generating useful insights.
It also reduces overconfidence because the thinker remains focused on possibilities rather than certainties.
That's important because certainty can be dangerous.
Extremely dangerous. Some of the biggest mistakes in history were made by people who became too certain.
What's the third difference?
They follow value rather than attention.
That's a great line.
Because attention and value are often very different things. The crowd usually focuses on visible opportunities. The strategist focuses on emerging bottlenecks. The crowd focuses on today's winners. The strategist focuses on tomorrow's constraints.
Many important opportunities begin with relatively little public attention.
Which explains why opportunities often look strange at first.
Exactly, if everyone already agrees, much of the opportunity may already be gone.
What's the fourth difference?
They position themselves for power law outcomes.
Meaning?
They understand that a small number of decisions often create a large percentage of results. They don't expect every action to be transformational. They look for asymmetric opportunities. They build optionality. They create exposure to favorable surprises.
This mindset appears repeatedly among successful entrepreneurs, investors, and innovators.
So they don't need to win every time.
Exactly. They need exposure to the few things that matter enormously.
That's actually very freeing.
It is, because it shifts the goal from perfection to positioning.
Let's bring all the patterns together.
Great idea. Imagine a strategist looking at artificial intelligence. They see a bottleneck shift. Intelligence becomes more abundant. They ask what becomes scarce next. They identify judgment, trust, and direction. They look for feedback loops. Which businesses strengthen as they grow? They think about power laws. Which opportunities could create disproportionate rewards? They use consequence thinking. If AI improves, what follows? Then what follows after that? Suddenly, they're not looking at AI. They're looking at an entire landscape of possibilities.
The technology becomes the starting point rather than the conclusion.
That's probably one of the most important ideas in this entire episode.
I think so too, because most people stop at the event. The strategist starts at the event.
That's a beautiful distinction.
Think about the difference. Most people see AI and ask, what does AI do? The strategist asks, what does AI change? Those are completely different questions.
And the second question often produces more valuable insights.
So maybe that's the ultimate definition of seeing the board.
Let's try one. Seeing the board is the ability to move beyond events and understand the systems generating them. It's the ability to recognize incentives, bottlenecks, feedback loops, power laws, and consequences. It's the ability to see not just what is happening, but why it is happening and what may happen next.
That's strong.
And increasingly valuable in a world where information is abundant, but understanding remains scarce.
Exactly. Which brings us to the final realization. The future will not belong to the people who consume the most information. It will belong to the people who build the most accurate models of reality.
Because information tells you what happened. Models help you understand what it means.
Exactly. And when you understand what it means, you begin seeing opportunities, risks, and possibilities that remain invisible to everyone focused only on the headlines.
Which is why learning to see the board may be one of the highest return investments a person can make.
Because the board keeps changing. Technologies change, markets change, industries change, the headlines change every day, but the patterns beneath them remain remarkably consistent. Learn to see those patterns and you gain an advantage that compounds across every domain of life. Throughout this episode, we've explored incentives, feedback loops, bottlenecks, power laws, optionality, and second-order consequences. At first glance, they may seem like separate ideas, but they're really different ways of looking at the same reality. They're different ways of understanding the board.
And I think that's the biggest lesson. The people who consistently get ahead are rarely seeing a different world. They're seeing the same world differently.
They focus less on isolated events and more on the systems generating those events. Less on headlines, more on underlying forces. Less on what happened, more on why it happened.
Exactly. Because the board is always moving. Technologies change, industries change, markets change, politics changes, culture changes, but underneath those changes, certain patterns appear again and again.
Which means the goal isn't memorizing every event. That's impossible.
The goal is recognizing the patterns that keep producing the events. Once you understand the patterns, you stop feeling surprised by every headline. You begin understanding how the pieces fit together.
And that understanding compounds. Every new trend becomes easier to analyze. Every new opportunity becomes easier to evaluate. Every new disruption becomes easier to place into context.
That's probably why this framework feels so powerful. It's not tied to a specific technology. It's not tied to a specific investment. It's not tied to a specific decade.
Exactly. Seeing the board is ultimately a way of thinking. It's a commitment to looking beneath the surface, to following consequences further, to identifying bottlenecks earlier, to recognizing feedback loops before they become obvious.
And maybe most importantly, it's a reminder that the future usually leaves clues.
It does. The challenge is learning how to see them, because the greatest opportunities are rarely hidden. They're often sitting in plain sight. The difference is that most people are looking at the event, while a few are looking at the pattern behind it.
Which means one of the highest return questions you can ask may be surprisingly simple. What am I looking at that everyone else can see, but few people truly understand?
Exactly. Because that's where advantage begins. Not with better information, not with better predictions, but with better models of reality.
And that's really what this entire episode has been about. Learning to see the board instead of just the pieces.
Because the board never stops moving, the patterns never stop interacting, and the people who learn to see those patterns gain an advantage that extends far beyond any single investment, business, or technology trend. The future belongs to those who understand the game beneath the game.
If you found this episode valuable, subscribe to Mindset Frontier AI on Spotify or Apple Podcasts. Follow us on X for elite mental models, billionaire psychology, adaptive thinking, and decision frameworks built for exponential worlds. And share this episode with a friend. Help us reach 10,000 downloads. Help us build one of the sharpest mindset communities online. This podcast is part of Finance Frontier AI. We run 4 different series: AI Frontier, AI, Finance Frontier, Mindset Frontier AI, and Make Money. If your company, framework, or idea fits one of our themes, visit our pitch page. You may qualify for a free spotlight.
You can also sign up for the 10x Edge. It's our weekly drop of elite frameworks, AI productivity tools, asymmetric thinking, and strategic insights designed to help you think and operate like the top 1%. No hype, no jargon, only at financefrontierai.com. And if you have a breakthrough story, a bold thesis, or a mental framework worth sharing, head to our pitch page. If it's a strong fit for the ecosystem, we may feature it in a future episode. This podcast is for educational purposes only. It is not financial advice, legal advice, business advice, or psychological guidance. Always verify information independently and consult qualified professionals before making important decisions.
The world changes fast. Technologies evolve. Markets shift. Institutions adapt. Use this show as a framework for thinking, not as a substitute for independent judgment.
Music in this episode, including our intro and outro track, Dreaming On Instrumental by Nefx, is licensed under the YouTube Audio Library license. Full details can be found in the episode description.
Copyright 2026, Finance Frontier AI. All rights reserved. Reproduction or redistribution of this content without written permission is strictly prohibited. Thanks for listening. We'll see you next time.
AI host mapping. Sophia is powered by ChatGPT. Max is powered by Grok. Charlie is powered by Gemini.
We do it now. We do it now.